Welcome back to the channel. Today we're diving into one of the most iconic investment books of all time, A Random Walk Down Wall Street by Burton Malkiel. Whether you're new to investing or you've been trading for years, this book has something that will challenge the way you think about markets forever. So grab a drink, get comfortable, and let's break down the key ideas, lessons, and big takeaways from this legendary book. A Random Walk Down Wall Street is all about the nature of financial markets and how extremely difficult, almost impossible, it is to predict short-term price movements. Malkiel introduces the idea of a random walk, meaning stock prices move unpredictably. No matter how much you analyze charts or earnings statements, he argues, nobody can consistently forecast what the market will do next. This idea goes directly against the belief that investors can reliably beat the market. And throughout the book, Malkiel walks you through decades of history, data, and real-world examples to show why so many people, traders, analysts, and even professional fund managers get it wrong. One of the most entertaining parts of the book is Malkiel's tour through market bubbles. He covers everything from the Dutch Tulip Mania to the dot-com bubble, to recent manias driven by hype and speculation. The pattern is always the same. Investors get overly confident, prices rise fast, people rush in because this time it's different, and eventually, everything crashes back to reality. These stories serve as warnings. Whenever the crowd believes prices will keep going up forever, that's usually when danger is highest. Malkiel's message is simple. Don't chase hype, trends, or hot tips. Emotion, not logic, drives bubbles, and emotion is the enemy of good investing. Malkiel then takes a deep dive into the two main schools of investing. 1. Technical analysis. This approach studies price charts, patterns, and indicators to predict future movements. Malkiel's view? Technical analysis often creates the illusion of control, but it rarely beats the market consistently. 2. Fundamental analysis. This approach looks at company earnings, management, valuation, and overall financial health. Malkiel respects fundamental analysis more, but still believes that even professionals using this method struggle to outperform the market over time. His conclusion? Neither method guarantees long-term outperformance, especially after fees and mistakes are factored in. This leads to the book's biggest takeaway. Most people should invest in low-cost, diversified index funds. Instead of trying to pick the next big stock time the market or predict short-term movements, just buy the whole market and hold it for the long run. Index funds offer broad diversification, low fees, consistent performance, and extremely low stress. Malkiel shows how the majority of active mutual funds underperform simple index funds over long periods. Not because the managers aren't smart, but because markets are efficient, costs eat into returns, and predicting the future is incredibly hard. If you want stability, long-term growth, and a simple strategy, then index funds are your friend. Another powerful part of the book is Malkiel's breakdown of human psychology. He explains how investors often sabotage themselves because of overconfidence, fear of missing out, loss aversion, herd behavior, panic selling during downturns. Even when people know what they should do, emotions often push them to do the opposite. This section makes one thing very clear. The biggest threat to your portfolio is not the market, it's your own behavior. Toward the end, Malkiel gives real, actionable strategies for building a long-term investment plan. He talks about how your portfolio should change at different ages, how to balance stocks and bonds, and how to manage risk without sacrificing growth. It's simple, realistic advice that anyone can follow, even if you're just starting out with a small amount of money. A Random Walk Down Wall Street remains one of the most honest, practical, and insightful books on investing ever written. Its core message is powerful. You don't need to beat the market to build wealth. You just need to participate in it wisely. If you're serious about investing, this book is absolutely worth reading. Thanks for watching. If you enjoyed this breakdown, hit that like button, subscribe for more finance and book review content, and drop a comment on what book you want me to cover next. See you in the next video.